Hello and welcome. Pep and I are talking business value today. Pep, we need to talk about the Hall of Shame because honestly, most CROs are building their business value practice completely backwards.
100%, Naisan. Mistake number one, treating business value like it's innovation consulting.
Yeah, 3-week workshops, anyone?
It's not a creativity seminar, it's a revenue engine. If it doesn't accelerate deals this quarter, it's fluff.
Yeah, absolutely. And mistake number two, you hire a value engineer with no plan and suddenly,
They become a slide factory, just churning out decks nobody reads.
yeah, absolutely. And the biggest one, waiting too long.
You're calling in business value only after a procurement team asks for discounts, you're dead. You aren't building value, you're begging for a lower loss.
We're going to break down exactly when to hire, who to hire, that Hall of Shame mistakes to avoid. Let's just dig in. Let's start with the basics because I hear a lot of pushback on this. Why does a CRO even need a dedicated business value practice? Can't sales or product marketing just handle this one ROI slide, Pep?
5 years ago, maybe. Today, no chance. The buyer landscape has shifted. CFOs, COOs are killing deals that have technical fit, but no financial fit. They don't care about features. They want economic clarity.
Right. So product, is telling about the how. Sales tells the story.
It does. And business value translates that story into the only language that the CFO speaks. Net present value or NPV, net dollar retention, risk mitigation. When you get that right, three things happen instantly. Win rates go up, deal sizes get bigger, and crucially, the sales cycle compresses.
That's right. Because now you're not fighting the why buy now kind of thing in the final hour, right?
You aren't retrofitting the value during procurement. You're armed from day one.
Yeah, I think that's absolutely essential. So let's look at the Hall of Shame, right? I kind of teased it in the intro, but if I'm a CRO standing up business value first time, what are these biggest pitfalls I need to dodge?
We've compiled a top 10 list, but here are the ones that will kill your deal, your company the fastest. First, innovation consulting. Do not build a practice that requires weeks of interviews just to get an output. It's not scalable. Second is the slide factory. Hiring a value engineer without a defined motion, they just end up making pretty charts for reps who don't know how to present them.
What about the firefighter pulling in procurement before it's too late?
You want to have the business value story early, along with your champions at the customer before you get the procurement.
I've got a favorite that I'm going to add, a third, this thing about no telemetry. What are your thoughts on that?
Well, telemetry is super valuable. I've found in my conversations that customers really respond to it. If your models are based on opinions rather than their own customer data, the CFO will tell it apart. Once you have that telemetry, it's addictive because it's their own data and they want to use it. They want to see it.
Yeah. And that's an interesting element because telemetry invokes product and we all think about, should this report into product and the huge reporting lines issue. Your thoughts on that?
Business value under product or marketing doesn't tend to work. It has to sit under the CRO. It is a revenue engine. It's a sales acceleration tool, not a content marketing function.
Okay, so now that we're clear on that, we know where it lands, we know these huge pitfalls. Let's move to what does good look like. If we strip it down, what are the actual elements of a practice? What does a good practice look like, Pep?
It's not one size fits all. You need a couple of things. You need scaled material. So these are things like value calculators and slides for the mass market, for basically everybody to use. You also need deal assist for the big ones, the whales. And eventually, you'll need something that looks like product integrated ROI, where the product itself tells the user how much money they're saving.
Yeah, tell me about it. You and I just did a huge project on that where we had one customer come back and tell us, you're selling our value better than we are. And that was probably the best praise you can get. But okay, let's keep going. How do we measure all this stuff? How do we make sure that all works?
Back to this being a revenue engine, we keep it simple. One, does it influence pipeline? Did the deal move faster? Conversion, did we win? Did we win at a higher rate than we would have otherwise? Deal size, Did we protect the price point?
I love it. Boom. That's it. That is your high level briefing. So if you've got 20 more minutes, stick with us. Me and Pep are going to unpack this quite a bit. How are we going to evolve a practice typically? Pep and I have both done that. How do you grow it when you're at a $20 million stage as a business? What's a 200 million? What's a billion plus? What does that look like? So if you want to know more about that, stick with us. We're about to unpack that. Otherwise, I'm going to say thank you for listening in and look for more content from us. All right, Pep, are you ready to hit the deep dive?
Absolutely.
I think we probably better talk about who we are just briefly before we dive in too much further. Do you want to give us a quick idea of your background and business value?
I've spent almost 2 decades building business value practices in enterprise SaaS at places like Oracle and Salesforce. I've led value frameworks and executive value reviews, supporting 8-figure renewals, expansion deals, and C-suite decision making.
It's incredible. And while I'm not as experienced in you in this area, Pep, I've got about a decade in business value. I count myself as a very passionate supporter. My background comes more from the technical, the pre-sales side. But over the years, I've led a number of teams, Tableau, Salesforce, built them up from the ground, built telemetry frameworks, built databases of value that could break down the value that customers received in vertical and horizontal use cases, and was able to sit down and turn that into a reusable resource. So I'm super passionate about value. All right, well, let's get into the deep dive, the playbook, the maturity model, all of this stuff. I want to play a little game to start with. I'm going to tell you my company stage, Pep. We're going to do a little roulette here, right? And you tell me, what should my business value practice look like? Okay, so stage 1, I'm just hitting like between the $0 and $20 million ARR mark. I have 5, 15 sellers somewhere in there. So I'm thinking I should go hire a value engineer first.
No, do not hire a value engineer yet. At this stage, you need what we call scaled value. A PMM org or a sales leader should build a core value narrative with a simple calculator. The math doesn't become too complicated at this stage. You need a consistent value narrative supported by that calculator. You need that consistency, not dedicated headcount.
Okay, I love it. Scenario 2, I'm growing. I'm now 20 million, maybe up to 80 million. I've got 30 sellers. What do I need now?
Now you hire. You get one value engineer. We'll call them a generalist athlete. Their job is primarily to deal assist. They jump on your top 20% of opportunities to help close. So ratio-wise, you're looking at something like one value engineer to about 10 sellers.
Okay, cool. Now let's say this company, which is doing amazing, is scaling even more. We're now at 80 to 200. We're growing quite a bit. We have 75 sellers, 80 sellers. What do you say now, Pep?
Well, now the game changes. You have more scale. You can't throw bodies at it, though. You need tools and telemetry. You need self-service ROI tools on your website so that helps provide scale. You hire 1 or 2 more value engineers, headcount. Maybe you add a junior analyst or a builder to manage the tools. At this point, your ratio is more scale influence. You go from 1 to 10 previously to maybe 1 to 15. Okay,
fantastic. And let's just say this imaginary company now, we've grown. We've gone now to maybe 200, 500, 600 million. We're hunting whales out there now. What does that start to look like?
And this is where the bespoke enterprise territory construct comes into play. You need senior value engineers that can run multi-threaded executive workshops. You're doing heavy financial engineering. Your ratio now bumps up to 1 to 20 or 1 to 25, something in that range, because it gets wider because your tools are handling the smaller deals.
Okay, so here we have that evolution. We've walked from don't hire someone up front, which is, I bet, going to be controversial, Pep. I bet people are going to be like, whoa, wait a minute, what's going on here? But I love that. And then the athlete stage 2, that kind of smaller, maybe this is like a series B or series C kind of. And then you've got step 3, you're really building up. You start growing to the 200 million. Now, let's also just talk briefly about what would happen next. Let's say you're 500, 600, 700, 800 million. You're now a public company. You're cranking along. What does that look like?
Well, that would be kind of the fully mature stage. You'll have a value leader, an established practice industry specialists, because by that point, your product would be more specialized for those use cases, and therefore the value statements will be more specialized. You'll have a tools team. Value at this point isn't a project anymore. You're building a system, a solid enterprise level practice. And at this point, your ratio is maybe about 1-30 in terms of
Wait a minute. That's a bit confusing because I think your ratios just went up and then down or something like that. Walk me through that. What's happening there?
As you get bigger, your product and brand should do more of the heavy lifting. You become more known for whatever it is. You're not selling your company so much as your solution and the impact that it can provide. Value engineers focus only on the most strategic and complex accounts at that point.
Love it. Okay. And I guess just to wrap things up, let's land the plane on metrics. So you've talked about win rate, we've got these ideas of influenced revenue, but you're going to go to the board and you're going to say, okay, I need 10 seats or 10 value engineers on my sales team. They're like, what is that? How do you tell the board that this is worth it?
You don't just focus on headcount. You're looking at basically 4 buckets. You're looking at number 1, pipeline influence. What percentage of ops have a business case attached to it? 2, velocity. Are deals with value engineers progressing faster than deals without? 3 is basic economics. Are we seeing a reduction in discounting, increased pricing power? And then 4 is expansion. And this is the sleeper hit. Business value is the biggest lever for renewals.
I love that. Yeah. And you and I have seen that a ton, haven't we? Because again, that story about the customer saying you're selling our value better than we are. When we see people, our customers come back and their eyes light up to realize what their team has delivered with your solution, all of a sudden it's this teamwork and magic that you're proving the value they already got, and that's amazing.
Yeah, that's always a great starting point for a renewals conversation. Like here's what you paid, here's what you made. That's how you get that multi-year renewal.
Yeah, absolutely love it, right? So, Pep, I think we've gone over the high-level blueprint. We got to probably do some more episodes to dig into what's that initial hire look like, and how do you do metrics and ROI? How have we built telemetry-based dashboards? How do you do that kind of stuff? But for everyone listening, don't build a slide factory. Build a revenue engine.
Amen to that, Naisan. So let's go sell.
Oh, I love it. All right, Pep, thank you so much.
Thank you.